going public, getting listed. This is the dream of many new startup companies and the unlikely exit for most companies. While most companies are not designed nor do they have a desire to go public, the importance of the public markets is imperative to the growth of a thriving economy and growing new jobs. According to Forbes, 65% of net new jobs come from new businesses include new startup. In this video, we will explain 3 reasons why retail investors always lose money in the IPO startup stock. First, lack of research and information. Most investors do not gather relevant data or conduct thorough research before investing. It is the backbone of successful investing. However, investors often make mistakes such as not studying the fundamentals of the company, not looking at the historical data of the stock, not paying attention to the market and the intrinsic value of the stock, not evaluating the financial growth of the stock. Apart from these factors, the stock market is also heavily guided by global and local market news. Investing in a stock does not end with buying a share you like. It is vital to stay abreast of the latest news related to the company and the sector you are heavily invested in. Second, trading against the tide of institutional investors. It is not the retail investors but the big institutional investors that govern the market movements because of the heavy volumes traded. They handle big money and have more resource of information for trading. At least, they are using Bloomberg Terminal for trading. It is often said retail investors enter when institutional investors exit and vice versa. This against the tide trading makes them lose their investment value. To avoid making this mistake, look at trade volumes to gauge the market trend of equity. Set up a stop loss to prevent major losses. Third, rely on opinions, not on data. Most investors rely on unknown stock analysts for trading and ignore the actual data of the stock. This is a major reason why retail investors lose money in the stock market. Nobody can provide accurate information about buying and selling. Therefore, decide your trade based on the credentials of the stock and its potential. Successful trading is based on a combination of knowledge, discipline, and persistence. As a retail investor, it is essential to understand, invest time in learning stock trading, and follow a disciplined approach to investing. Start small and grow your portfolio gradually once you have understood the nuances of the stock market. For the conclusion, as much as investors wait for the next IPO in anticipation of multiplying their wealth quickly, the fact remains that only a small percentage of these IPOs yield lucrative returns. On the contrary, the odds of losing money are much higher. Retail investors must therefore exercise complete caution and do thorough due diligence from their end lest they end up losing their hard-earned money and are left in a lurch. Reflecting the same sentiment, Warren Buffett said at Berkshire Hathaway's 2016 annual shareholder meeting in Omaha, Nebraska, "You don't have to really worry about what's really going on in IPOs. People win lotteries every day, but there's no reason to let that affect your investing strategy at all. Instead, the focus should be on building a quality portfolio consisting of 10 to 15 simple, predictable and dominant businesses with strong balance sheets, free cash flow generation as well as clean and efficient management. This is the key to consistently generate secure, inflation-adjusted, risk-adjusted, and tax-efficient returns in the long run." Well, that's all our truth that we should tell. We hope you are be richer and prosperity after watch this video. If you like this video, please give it thumbs and share. Thank you for watching.